We have some applause here for us. We are ready to go.
Love it.
Not sure who's on here, but we are going to kick this mule and get this thing started. My name is Rob Ross. I'm the Executive Vice President over here at Intercoastal Mortgage based out of Reston, Virginia. And I'm in my casual, comfy clothes working from home today, and that's a good thing. But we are here with a few people as we kick this off. I'm here with my partner to your left, if you're facing the screen, Chris Kearney, Senior Loan Officer with Intercoastal Mortgage in the Ross Group. Chris and I have worked together for 15 years. Excuse me, this guy to my right, Adam, he is new to the team, and he's going to be sitting here learning today. And, we're excited to have him as part of the team as well. We are going to add the presentation to the screen here right now so you can see what we will be talking about today. We are currently live on Facebook on the Ross Group business page. We're live on LinkedIn. We're live on my YouTube channel and X. So if some of you are watching from those platforms, we really appreciate you being on there in advance. We promise to make this a little bit fun today, interactive as well. There's a comment section to your right. So if you're on here, feel free to post comments. If you share a really good comment, we'll share it to the screen and you'll get to see it live on the screen. And between Chris and I, we will answer these. Our partner, Alec Gagné, is heading to a settlement, and we're not sure if he's going to pop on here and grace us with his presence. He's having a great month and heading to a settlement, and that's hopefully what we're able to do for some of your clients here soon. So as of right now, let me click back here. The slide started moving on us. Again, my name is Rob Ross, Executive Vice President over here at Intercoastal Mortgage. And today we're going to be talking about some unique non-QM lending solutions for real estate agents. Let's face it, it's a tough market. It's always a tough market. This market's been kind of interesting ever since COVID hit. And one of the things that we have to figure out and do as real estate agents and lenders is how can we get more deals in the door? And a mistake that I've found a lot of our real estate agents make is that you guys will meet with a client and the client's going to tell you a lot of stuff. They tend to tell you a lot more upfront than they tell the loan officers. And they'll let you into their personal lives. They'll tell you, a lot of them will divulge a lot of stuff very quickly up front to you. And some real estate agents will say, well, I don't know that I can be helped. I don't know that I can obtain a loan because here's why. I have lower credit, or I don't have income to verify, or I'm self-employed. They'll give all these reasons why they as buyers have not bought and that they don't think they can. I've met real estate agents that would say, oh yeah, that's going to be challenging. I can't help you out. And they'll punt that client right away. Well, real estate agents, don't punt that client right away. That's money in your pocket in the future. And by the way, there might be some buyers listening into this webinar today. Buyers, you need to hear this as well. If your real estate agent tells you that, doesn't mean they're a bad realtor. It just means you need to call the Ross Group and our team so we can show you some of these unique lending solutions to help you get into a home. When you pay $3,000 a month in rent, do you know Chris, what's your interest rate when you spend $3,000 a month on rent?
That would be 100%.
That's correct. So if you're spending money on rent, your interest rate's 100%. So some consumers will say, well, rates are a little higher. I want it to go down. Well, what are you currently doing? Well, I'm currently renting. Well, your current interest rate's 100%. So 6.5 is not that bad, or 5.99 is not that bad. Let's get you down 95% lower and let's build some equity for you. So without further ado, let's roll through some of these non-QM lending solutions for real estate agents. And again, I'm going to post a comment just to make sure it's working. Make sure you guys can all see that, and we will get going here. So first and foremost, our team members, myself, Chris, Alec, Adam's not on the slide yet. We'll get him up there soon. And Claire Fleming, she is mother hen. She hates when we say that. She is keeping everything together. She's our top senior processor. She's been with the team 13 years as well. Without Claire, we don't get deals to closing. So Claire's amazing. Let's talk about a few things here that we do well. And we're going to roll through this pretty quickly. We are not your plain vanilla Rocket Mortgage. And yes, I'm going to say it. I don't really care. we're one of the best lenders out there in the nation, even though we're regional, because we have unique lending solutions. We do portfolio and non-QM loans, which is going to be our focus today. We have other webinars coming up throughout the year where we talk about construction lending specifically, bridge loans, which are amazing. And then I'll let you read through that. 2-1 seller buy downs, vacation and investment properties, home equity lines, 5 to 9 unit new to Intercoastal. Residential is usually 5 unit or under. Usually when you go above 5 units, 4 units or under. When you hit 5 to 9 units, that's usually considered commercial. We have some options for you. Non-mortgable condos, and let's say at 9-day closings. That's something that's going to help you win no matter what. So we're going to go in here as a follow-up. We immediately follow up with your clients, real estate agents. If you send us something, they're going to pop into our CRM. We're going to call them, get to them right away. And we're going to make sure things happen very quickly for you. And we're going to jump on those clients and treat them like family. Let's talk about some challenges. We're going to call this agent challenge number 1. Let's say you as a real estate agent, you're writing a contract and an offer, and you're going to ask for a seller credit. It's late and you can't remember what the maximum allowable contributions are. Well, we are going to take a step back because, Chris, I think we have the wrong slides uploaded here.
Yeah, it's the right information on there, but we have a chart.
We have it.
Send
we
out
have the
to
right
you
one.
that visualizes it, pretty clearly and gives you all the right answers. But these are the right answers too. But we have a chart that we can send to you to make it a little easier to read.
Yeah, I made a mistake. This is the right presentation. This was a chart for you. We can send you the chart. But a lot of agents will call us and say, hey guys, making an offer, what can my seller contribution be? You can always call us. We're always going to tell you what that is. But this is a nice breakdown that tells you per loan program what you can actually do. So let's click to the next slide here. Alternative lending solutions from ICM, the non-QM difference, which is really what we're talking about here today. Okay, what are non-QM characteristics versus your plain vanilla loans? And non-QM, just because there's a lot of acronyms out there in the mortgage industry, means non-qualified mortgage. So basically a loan that will not be sold to Fannie Mae or Freddie Mac. You have expanded ratios. You have debt income ratios that can go up to 50%. Many of these programs don't have PMI, private mortgage insurance. We have very flexible income sources, which we'll talk about. You can potentially have a 40-year term. You can potentially do interest only, and we can do manual underwriting. Okay, manual underwriting means, again, we're not reliant on that Fannie Mae, Freddie Mac automated system to determine your future. We have a little more flexibility. We can figure more stuff out that way. There's pros and cons to it. The cons, the interest rates might be a little higher. But hey, if you're in a scenario where you don't qualify for a traditional mortgage and you need that non-QM loan, again, non-QM is a little bit higher than the market. So if the market's at 5.5% to 6.5%, non-QM might be from 6.75% to 8%. It's not 100% what you're paying in rent. So again, these are things that are there to help you. Let's talk about a little bit of the non-QM expansion. And we're still have some updated numbers for 2024 coming in. These things tend to run a little bit behind. But basically, originators started adopting this non-QM stuff about 10 years ago. And one of our prime investors for non-QM came and spoke at a rally for us recently, one of our sales rallies at our company. And a really interesting stat was about 10 years ago, non-QM represented about 30 million in loan volume across the US. It was very minimal. Well, now they're doing well over that per month, right? So some of these, the non-QM market is in the billions now, and we won't get into how many billions, but billions and billions. And it is growing. And that just means it's becoming more popular. So you as real estate agents watching this today, you have to understand non-QM. You have to be able to speak a little bit about it. And then you do the nice passing of the baton and you hand them off to the Ross group so we can really take them to the next level and get them to apply. here's kind of the evolution of non-QM. So kind of like I said, 10 years ago, 11 years ago, 2016, under 10 billion in some cases. The projections are even higher right now. So this just gives you a nice little chart of projections there and what's happening. Chris, do you want to take agent challenge number 2 and we'll kind of go back and forth here?
Sounds good. So challenge number 2 is your client owns a limo service and has 3 years in the business. He does have 2 years of tax returns, both business and personal, but like a lot of savvy business owners, they might take some liberties writing things off and not claiming as much as they actually take home. However, the asset statements can show the money. It shows the deposits, shows the money that's coming in. So what can we do? Well, that is literally a great example of a client that could qualify for a bank statement loan. A bank statement loan is pretty much exactly how it sounds. We qualify people based off of the bank statements from their business that shows the money coming in, whereas tax returns or other forms of income may not show the full story. So it's all about the deposits with a bank statement loan. Now, a couple different ways that this can go. There are 12-month bank statement loans. There are 24-month bank statement loans. Interest rates can be slightly different depending on how far back we go, whether it's 1 year or 2 years, but no tax returns, which is the beauty, right? So we're literally qualifying people based off of the bank statements for their business. Now, this could also be personal bank accounts. This could be bank accounts from their business. If they're business owners, whether it's an LLC or an S Corp, however it's structured, we can use bank statements from the business as well as their personal, depending on how that money comes in. And we can calculate all of that pretty quickly, right? So this isn't like, it's going to take us a week or 2 weeks to figure out if we can use this income. It only takes us about a day, right? 24 hours to, once we have all of those statements, to run through everything and calculate the income that we can use based on the cash flow that they have. A couple other highlights here is that this program does not require 20% down. Like a lot of these kind of portfolio specialty programs might. You only need 10% down here. 10% down, no PMI. So really favorable terms there. And there really isn't a limit necessarily on loan amount. So, we can provide loans here, $100,000 up to, 3 million. So, tons of room. And these are also not restricted to primary residences. These, bank statement programs can be used for, really anything: a primary residence, a second home, a investment property. Rates will obviously change depending on what that answer is, but there's tons of flexibility with this program. So great news.
Perfect. All right, agent challenge number 3. I had a comment over on the Facebook page. Someone just said, Chris, is there anything such as a 36-month bank statement program? Can you get better if you give more?
It's a great question. Not that I am aware of. I think 24 months is as far back as it goes right now.
Yep.
So, and that's true for a lot of programs, whether you do a full underwrite and collect tax returns, it's usually just the most recent 2 years that lenders will look at. So that for bank statements, 24 months or 2 years is the farthest back that we would go.
All right. Yep. Perfect. So I'll jump in here to agent challenge number 3. I just met an amazing lady who has $3.5 million in checking. I would say she's pretty amazing with that. And another $1.5 million in retirement. She does not have a job currently, but that shouldn't be a problem, right? So I've had a lot of agents call me and go, Rob, I've got someone with a ton of assets. They're not employed. That's not an issue, right? Well, historically in the past, you would say, unfortunately, it is an issue. If they want to obtain a mortgage, it's based on your debt to income ratio, and your debt to income ratio, if you have zero income, is 100%. That's not good. So that wouldn't work. Now, in this scenario, I might say, how big's the house they want to buy? Oh, it's 500,000. We'll just have them pay cash for it because they have $3.5 million. So again, that would be a very nice deal and a very nice problem to have. Well, right now, Even if they don't have a job, we do have some solutions for you. So let's talk through that. This is known as the Asset Utilization Program. And with asset utilization, some of the nice key features here: 660 minimum credit score. Doesn't have to be 700 plus. Loan amounts up to 3 million. So tons of flexibility. We're all pretty happy as lenders and agents when a client's buying a $3 million home, but we're going to help you with this product, even if it's under 3 million, not a problem. The loan to values on these go up to 80%. You can do purchases, rate and term refinances, qualified assets. You can read what's on the screen here, and we're going to send you a copy of this presentation. Let me give you a better example below. That 3.5 million in assets, we're going to divide that by 360, and in some cases 240. So sometimes it's a little bit less, and they're going to give you, voila, here is your monthly income that you can use. So we are able to take whatever your total assets are, divide that out by a certain number, depending on the investor, whether it's 240, 360, and we're going to come up with a monthly income. Now, whatever your down payment is, we do have to subtract that from the total. So if you have 3.5 million and you're buying in assets, you're buying a $1 million home in Vienna. Maybe that's a lot in Vienna, but you're buying a $1 million home in Vienna, and you have 3.5 million in checking, and you know you want to put down 500,000. Well, we're going to subtract the 500,000 first, because that's your down payment. You're no longer going to be able to derive income from that because it's gone. And then we're going to take your 3 million remaining, divide that by the appropriate number. Voila, there's your income. As long as your debt to income ratio is now under that 50% mark, you now qualify to buy a home, obtain a loan, literally with no employment. You're putting retired or not employed on your application. So you meet clients that are asset heavy and they don't know what to do. We can use an asset utilization. We on the mortgage side call it asset depletion. Same thing. Whatever you want to call it, same result. But that is an agent challenge. When you meet that client that says they don't have a job, go, but I want to buy a home. Don't walk away. Say, oh, you don't have a job. That's fine. But you want to buy a home. Well, we need to connect you with our lenders to see if there's a solution. Do you happen to have some good assets? And if they say, yeah, we've got really good assets, then connect them with us. Let us do the dirty work and figure out whether we can make it happen or not make it happen. And better yet, let me remind you of this. With the Ross Group, we're not just going to tell your client no. Our job is to educate clients, right? We're not salespeople. We are educators. Just like we're educating you today, our job is to educate clients on, hey, you can't purchase right now, but if you do A and B or A, B, and C, then you're going to be ready to purchase 12 months from now. So our job, when you're giving that golden handoff to the Ross Group, our job is to not shut down a client, make someone feel bad. Our job is to let that client know what they can do, whether it's now or later. Asset depletion, asset utilization, that's one of the best products out there. I'm going to talking baton back to Chris.
Perfect. All right. So next challenge is, you met this amazing couple and they're looking to buy their first home, first-time home buyers, always excited. They mentioned that they are not U.S. citizens. They have an ITIN number. If you've heard that term before, ITIN, what solutions are there? I know that changes the rules for lending, but what can we do? Well, that is an ITIN loan. ITIN numbers are for individuals who don't have Social Security set up just yet, or Social Security number. They have an ITIN number, right? So if we go to the next slide, there we go. So this is what the ITIN is. So basically, these are folks who are, they're not eligible for a Social Security number. So this is the identification number that they need in order to pay U.S. taxes. So this changes a lot of the rules, right? So, standard conventional loans, Fannie Mae, Freddie Mac, FHA, all the normal stuff that you're used to seeing, those programs don't accept ITIN borrowers. Okay, so that's why there's a special program just for these types of folks that we can do. So how do we qualify them? Well, we obviously look at their ITIN number, and we show, what their, just like any other, type of scenario, we have to look at their employment, their income, and verify that they meet the debt to income ratio, all of those types of things. Down payment required. You don't need 20% down for this program. You can do 10% down as well. So there's some flexibility there. But we're looking at, when we look at credit, normally you look at someone's social security number to pull their credit. Well, these folks don't have that. They have an ITIN number. So credit, there's flexibility because a lot of these folks have newly established credit in the US. So they don't have a big, long history with, 800 plus scores because, most of the time they just haven't had enough time to build it up. So the credit that we look at for an ITIN program is viewed a little bit differently, but there's flexibility to those credit scores that we do use. So that's the beauty of the ITIN. It's a great program for those folks that need it, and rates aren't that much higher either. They're not 10, 11, 12%. These are usually about 1% or so higher than conventional rates. So still well within reason to get people to qualify.
Oh, I was on mute. So I just posted a link in the chat directly to the IRS that can give you a little more insight on exactly what an ITIN is and how you obtain one if you do need one. So I will unpost that comment and we will jump to the next agent challenge, realtor challenge. You met a new crazy investor client who makes you want to roll your eyes. They are part of an LLC. They want to buy 5 homes in 5 weeks. The LLC has the cash for the down payment, but their income may be a challenge. We've dealt with these clients before. I've had those clients before. I'll admit there's been moments in my 24, 25-year career that on the other side of the phone, maybe I did roll my eyes a little bit because I was like, there's no way these clients are going to be able to buy 5 homes in 5 weeks. Historically, that used to be the case. We have a really popular program, which many of you on here have already heard about, but it's always good to have a refresher. And that is known as the DSCR loan. And that is a game changer for investors. Okay. The DSCR loan stands for debt service coverage ratio. Historically, DSCR is more of a commercial lending term. Not anymore. It's now on the residential lending side. And we have 6. Am I doing this right? 6. I can't do it. 6 outlets for these folks. And what I mean by 6 outlets are we have 6 national investors that we can work and sell to. So each DSCR investor might have a little bit different guideline or rule, and we're able to really navigate and make that happen. So let's talk about this DSCR loan for that crazy investor. By the way, we love it. Investors, possibly you, little Step Brothers reference. We're going to change our logo, Chris, to Prestige Worldwide.
That's the name of my men's league basketball team as well. So
it is. He's not even joking. That is Chris's men's league basketball team. It's Prestige Worldwide. It's weird because they play on an 8-foot rim. So I don't know. But let's go into this. Have you ever had clients that were self-employed? Yes. Business owners? Absolutely. Serial investors, and I don't mean Frosted Flakes. Just switched from W-2 to 1099. That is not music to our ears. We freak out when that happens. Less than 2-year work history. Creative tax returns. Yeah. All these check. Steve Dunleavy. Yep, you're right. That's a very good song that I won't repeat out loud right now. Oh, that's so funny.
Good call, Steve.
Mentioning your song you've referenced, Steve, there is a photo from that scene. Investor special, possibly you. No income, no self-employment history. 20 to 30% down is required for some of these investor specials, these DSCR loans. You only need a 660 credit score. You can buy 1 to 4 unit properties, but if you remember the first slide, surprise, I need to update this slide. You can actually do a DSCR for a 5 to 9 unit property. Yeah, you heard it right. 5 to 9 unit property, you can do a DSCR. Gift funds are allowed. So if you need to put down 20 or 30%, you can have mom or pop. Hey, maybe you crack a Bud Light. Hey, Dad, I need 10% down. I need $100,000. Maybe Dad's going to give you that 100 grand. You're going to toast that Bud Light, whatever your drink of choice is, and you're going to get those gift funds. Use the rest of your funds to bridge that gap, and you're going to be able to start buying some investment properties. The Ratio. I think that's a movie on Netflix right now. It's called The Ratio. Gross rent. It's all about DSCR loans. It's really good. Total monthly payment and subject property. Let's go into that. Let's focus on the one that has the big line there. Gross rental income. Proposed PITI. That's a 1 ratio. Okay, this would be a lower price property at $1,000 a month. Think of it this way. As long as your monthly payment on your new DSCR investment property loan is at least, so you take that, as long as your monthly rental income on the property you're buying is at least 75% or more of what your monthly payment is, you can qualify for a DSCR loan. Chris, what do you need for a DSCR loan?
Not a whole lot. You need down payment and credit score.
There it is. I was going to say down payment and a credit score, maybe a driver's license. That's about it.
Yes.
You barely need anything. And for employment and income, there's nothing listed. It's literally blank. We don't care about your employment.
Zero.
You don't have to be employed. You don't have to have income. You don't have to verify income. Some people choose this just because it's easier. They can actually verify income, but their tax returns are as the Leaning Tower of Pisa, Leaning Tower of Pizza, and they don't want to provide those tax returns. And hey, you're not going to hurt our feelings. We'd rather put you into the DSCR. It's an easier process. Rates aren't that much higher. You're talking high 6s to low 8s. High 6s would be very aggressive right now, but high 6s maybe with a couple points to low 8s. And you can buy unlimited rental properties. You might ask, well, how do you know what the rental income is? Herein lies the tricky part. The rental income, when we order your appraisal for your new property, for an extra $150 to the client, we have to order what's called a fair market rental analysis. So that appraiser is going to give you an appraisal on your property and say, yep, it appraised, looks good. And they're going to give us, the lender, a fair market rental analysis and say, if your client buys this property for this price, here's what the monthly rent's going to be. As long as that monthly rent is 75% or more of your monthly payment, you qualify. If it's less than 75%, say it's 72%, I'll be giving you a call to say, you're really close. We need to put a little bit more down payment down, or we need to buy down your interest rate to make sure it gets within the 75%. It does not mean you're dead in the water with the Nina, the Pinta, the Santa Maria. Okay, now I'm singing the song. It doesn't mean you're dead in the water. It means we have to get more creative to make this happen. And that is how a DSCR loan works. I'm not going to read all this other stuff here on the page. We're going to send you a copy of this. We're all professionals here. I don't need to read bullet points to you, but that is the essence of a DSCR loan and why it's so popular. So those serial investors, we quit rolling our eyes. When they call, we're very serious. This might be a great client for all of us. They want to grow their portfolio. They want to build wealth through real estate. And we all know on this call that some of the greatest wealth ever built in the US, if not the greatest, is built through real estate. DSCR cash flow, couple high points here. You can go up to the 80%. You can do some non-mortgable condos potentially. It is investment properties only. I think that was clear, but let me just state that. You can use seasonal and rental property income. So if this is an Airbnb type property and you don't have a 12-month lease, we can figure out what that looks like. We might even be able to take, if you have a rent roll from the property for the past couple of years, we can take that. We can average that out. So there's a lot of ways to make this happen to build that real estate portfolio. Right. Go ahead, Chris.
Rob, you just answered a question that just came through. I don't know if you saw it in the comment section. So Eliza just asked, what if it's an active Airbnb and the seller can provide a P&L and booking rate? So as Rob just mentioned, short-term or seasonal rentals can work. Absolutely. The longer the history we have, the better there. But yes, that can absolutely be used. So that's a great
perfect.
question.
So thank you for that question. We have posted that for everyone to see there on the screen. And that's a great question. That's a common question, but a great question. So why are you so sweaty? Why are we so sweaty after? My palms are sweaty from this one. And it's not because I was just watching Cops, right? So example one, Chris, why don't you take us through these examples? I'm a little parched here.
I know, I get excited about this program too. So wait, go back one. There's two examples.
Oh, there we go.
Example one. Sorry, it's a little faint on here, but walk through the numbers with me, because these are two examples that we've done for folks pretty recently. Even though these rates on here are showing a little higher, we're actually seeing some improvement there. So example one, this is for a single family purchase in DC. These folks were able to get a property at an $800,000 sales price. They were bringing 30% down. They could have only brought 20, but they had some money that they wanted to bring. So it ended up being 30% down. What you see on the screen here is 8.875 with 1.75 points. I would say that today that's probably closer to, like low 8s, if not high 7s with 0 points. So the rate and points on here are a little outdated in a good way, right? Because things have gotten better. But let's keep going through the numbers. So in this example, the monthly rent that they would receive on this property comes out to about $5,400 a month. Okay. Now, based on their down payment and interest rate and everything else, their loan that they're qualifying for with us, the total mortgage payment, taxes, insurance, everything comes out to $5,400 a month. So this is a very simple example, but gives you the idea. When you have rental income of $5,400 and your mortgage payment of $5,400, that's a DSCR ratio of 1, right? So they cancel each other out, right? It's rent divided by mortgage. So rent 5,400 divided by mortgage 5,400. Ratio is 1. You qualify, good to go. No income, no employment, nothing else needed, right? So easy one. Now, let's go into a different example. Example number 2. So this is for a 4-unit, a multifamily property in Maryland. Sales price is 1.2 million, and these folks had 25% down. Usually when it gets to multi-units, so like 2 to 4 units, rates get a lot better when you bring more than 20% down. So these folks wanted to do 25. The rate that you see on here is 9.375 with 1.5 points. Again, I think we're better than that today, which is great. But so what we'll do, but we'll keep going through the numbers. So the rent, so it's 4 units, remember, each unit brings in $2,000 a month in rent. So it's a really nice setup. So across the 4 units, $8,000 that these people are getting monthly in rental income. Awesome. Now, here's the tricky part, right? Because at this down payment, interest rate, right, their mortgage, the taxes are pretty high. Insurance for a 4-unit is more than a single family, right? So there's some things to factor in there. Their total mortgage payment on this property at the time is $9,300 a month. So if we do our ratio, just like we did on the last one, we're doing the rent divided by the mortgage. Well, 8,000 divided by 9,300, that's not cash flowing. That's not canceling each other out, right? 8,000 divided by 9,300, that gives us a DSCR ratio less than 1, right? We're at 0.86. But the beauty, guys, is that with DSCR, you don't have to break even. You don't have to cash flow, as much as that is, of course, a goal of a lot of these types of buyers. You don't have to. You can still qualify even if the rent does not perfectly match up with the mortgage payment. As long as that ratio is at least 0.75% or higher, using these numbers on the screen here, we're at 0.86, so we're good. You can qualify. So that's something really nice to know, because some investors can use tax benefits or incentives to justify that type of gap, and things of that nature. But those numbers can work even if they don't cancel each other out. So DSCR loan has been growingly, increasingly popular for those reasons. So all looks good.
Perfect. Well, we understand how valuable your time is. That's why we do this from 11 to noon, so you can still make that lunch. We try to roll through these things in 40 minutes. We try to keep it relatively fun for a subject that is otherwise boring for many of you. But we wanted to see if there are any other questions. We are going to be doing more webinars like this. We will send out a recap. We will actually give you all future webinars for the year. It's actually really important to us that you do go to that StreamYard link and you sign up for those in advance so we can prepare. So when we send out the recap to everyone who attended, hey, go ahead and subscribe to all those and register. It's free. Get it on your calendar so you can build out your calendar for the year. Be proactive with it. We're going to talk about bridge loans. We're going to talk about construction lending. We're going to talk about all sorts of new things this year on how to grow your business and how to educate yourself as real estate agents just to be the true experts. Because just like we as lenders are shopped on loans, I know sometimes you as real estate agents, your clients shop you as well. They want to check your expertise. They want to know you know what you're doing. And if they are debating between you and a real estate agent from XYZ Real Estate, you want to make sure you get them to sign that buyer broker agreement with you and not the competition. So we're here to help you grow your business. In turn, we would love to grow our business. We'd love a chance to work with your next buyer. I'm not doing my job if I don't ask for that. So if you have a buyer to throw along, give us a shot. If you haven't worked with us, I see a lot of folks on here on our Facebook page and some of our other live pages that work with us consistently. Again, we really appreciate that. And on behalf of myself, Chris Kearney, Alec Gagné driving to settlement, go Alec, and Adam joining our team. Remember, the Ross Group, we're always working together to serve you better. And we will see you on the next webinar, maybe at happy hour in a few hours. We'll talk to you soon. Take care.
All right, guys. Thanks for joining.